The Share Pickers Podcast with Justin Waite. Building wealth through investing. For more information, visit sharepickers.com. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the Share Pickers Podcast, episode 4, entitled Mistakes. In this podcast, in this episode, I want to talk about some of the mistakes I've made and what I've learned from them. And the quote is this: mistakes are only mistakes if you don't learn from them. Otherwise, it's a lesson. I completely believe this, and I'll explain why in a bit. But if you like this podcast, then please, follow, subscribe on the platform of your choice, please, okay? Okay, as in life, when it comes to investing, you will make mistakes. It's inevitable. They will hurt, as the pain of a loss hits twice as hard as the pleasure from an equivalent gain. And you will continue to make these mistakes unless you consciously choose to learn from them. My advice is, write your mistakes down. Build them into your stock picking strategy. Never dismiss your strategy, as it was built through the experience of mistakes, which have become lessons. You should never worry about making mistakes. They will make you a better investor. I would say when you start off, make sure you diversify. Don't put too much in one stock, because you will make mistakes, okay? Don't worry about that. Don't think about getting rich. Think about how much am I going to lose here. That's what you should think about, okay? You can read all the books or watch all the videos you want on investing, but nothing can replace personal experience of making mistakes and learning from them. You can, an example, an analogy of this, you can't learn to cook a good dish from a book. You actually have to cook. You have to burn it sometimes. You have to get it wrong. You have to taste it. So investing is not only about picking winners, it's about avoiding losers. And if you can learn to avoid the losers, you are left with winners. Okay, I'm going to mention 5 mistakes I've made that have helped me become a better investor. Mistake number 1, I didn't do my own research. I've been investing for a long time now, more years than I can remember, but over 20 years. But I originally invested in bigger companies. I didn't have really a strategy. I was in funds as well. And then I realized that you can make more money or get more reward from small cap, micro cap stocks, but they carry more risk. And when I moved down from investing in large cap companies to small caps many years ago, I blindly followed a tip from a known micro cap investor who didn't display their name or their image on Twitter, but he seemed like a decent guy. He seemed like he knew what he's doing. And small cap, micro cap investing is a lot different to investing in bigger companies. And this guy talked a good game, right? The result, the stock I invested in halved in value and share price in a month. Meanwhile, this person sort of moved on to pumping the next stock. I asked him, why it'd gone down. He just said something about sellers or something. Now, one of the worst things you can do as an investor is to not only blindly follow someone else's tips, but then if it goes wrong, blame them. My lesson here was I now do my own research into every company I invest into. Why? Because I'm in charge of my money and what I do with that money. I have to take responsibility for this. No one forced me into investing into that stock, and I often say, no one had the password to my stockbroking account. I logged in, I hit the buy button. If I blame someone else for the price going down, I am not taking responsibility for my mistake. Therefore, I can't learn from it. So if I don't learn from it, I will probably make the same mistake again and again until I do take responsibility for my own mistake. If I lose money on a stock I've researched myself, I can figure out where I went wrong. If it's someone else's research, I'm just relying on it. I have no idea. So if it's my research, I can ask, why did I lose money? Was the company overvalued? Did I believe the hype? Did I just jump in? Did I suffer from fear of missing out? There's always a reason for a bad investment decision. And where there's a reason, there's a lesson. But if I don't know why I lost money, I can't learn from it, okay? As for following people you trust but don't really know, ask yourself, what do I know about this person? And I'll give you an example. If you invest in a fund and don't do any research, at least that fund shows you its investment performance over many years. So you know it has a decent track record. If you follow someone who seems like they make the odd good tip but never show you their long-term returns, how do you know they make money? How do you know how good an investor they are? There are people on social media who don't show their real name, they don't display their picture of their face, and they give tips and they promote stocks all day. In any other walk of life, ask yourself this question. Would you give your money to someone who said they're a decent investment for you, but you didn't know who they were, what they looked like, what their name was, or how good they are at investing? The answer is probably no. So, always do your own research. If you don't know where to start, then just start by reading the news released by the company, then move on to the company's valuation. Try to work out why it's currently valued where it is and why you think it should be worth more in the future. Think value, not price. If you're still stuck, ask questions, ask people. But I would avoid people who are overly promotional in one company because they're already invested, okay? Or if you can, they may boost you, though, on Twitter or something, if they're not showing their real name. Ask them why they think it's going up, Ignore people who just give arbitrary price targets with no financial or fundamental basis for those targets. You can only learn if you do your own research. Mistake number 2. I bought a debt-ridden company. This is early on in my small microcap investing career there. The company was called Snoozebox. It showed some top-line growth, but they were loss-making, and so they couldn't service their debt. And I didn't really understand, that. I didn't really see it. Result? Snoozebox went bust. I got out having lost around 80% of my money. Luckily, I didn't have too much money in there. At the start, when I started investing in microcaps, I was quite careful, so I did diversify a bit. The lesson from this, I now avoid small companies with debt. Why? It's a known risk. There are unknown risks and there are known risks. And you can avoid known risks. And there's plenty of other opportunities out there without debt. Debt complicates the picture. Keep it simple. As Warren Buffett once says, investing isn't like Olympic diving. You don't get awarded points for difficulty. Keep it simple. Mistake 3. I didn't look at or understand the cash flow statement. I sort of understood, profit and loss, revenue went up, increases. That's what I sort of looked at. And that's a very important part. Growth is very important when it comes to small cap companies because that's what you're looking for is growth. But you've got to check out the cash flow. That's the real cash going in and out of that company. The company was utility-wise and seemingly had very good top-line growth, but they were very aggressive on their accounting. And it turns out they weren't actually taking in that cash. They'd booked revenue-wise. What happened? Utility-wise went bust. There's a theme here, right? And I think I was about 70% down, I think. And I started selling out on the way down, so I didn't lose a hell of a lot. But I still learned a lesson from that. And the lesson was, I learned about and always look at the cash flow statement. And you can just go on YouTube and just Google cash flow statement, or profit and loss account. It's free these days. You can go on the internet. It's free. Spend your time. If you want to be a good investor, spend your time putting some research into it. You can't just be an excellent investor overnight. It takes time and effort, but you can become a very good investor if you are prepared to put the work in. So do it. Just research it. Mistake number 4. I invested in a good idea, not a good business. This is very important. Try to invest in a good business. What do I mean by that? I'll give you a couple of examples. There's a company called Xeros, which is a water sort of conservation tech. There's a company called Blur Group. There's also a company called Bidstack still out there. And they're all good ideas. But there's no commercial proof of concept here. They're still loss-making. In fact, I think Blur went through. I think it changed its name, went through. What happened is this. Xeros conducted a fundraiser at 80% discount to the market price. Bidstack superbly missed forecasted revenues. I also lost money on Blur Group. I got out to Xeros at a small profit because I averaged down when they raised the money and it bounced and I got out. And I made a profit on Bidstack, but only because I acted very quickly. The story changed. Okay. So the lesson I learned from this is now I only invest in companies with a proof of commercial concept, i.e. top-line growth with a line of sight to profitability. Don't believe what the managers say, only what they do or what they release in their financial results. Just because they say the company has massive potential doesn't mean they will achieve that potential. If they talk about the size of the market, the potential, a huge slice of that pie they can have, don't just believe that. It's got to be proof of the pudding in the financials. Are people demanding their product? Are they growing very quickly, top line wise? I mean, if a management has a record of exaggerating, underperforming, being economical with the truth, do not, I repeat, do not give them a second chance just because you think you're going to earn a quick buck. I now will only give management one chance. If the news does not reflect the plan a second time, I exit and will never re-enter. I will exit as fast as I can. There's plenty of other opportunities. Trust me, if they've exaggerated twice, they'll do it again. They won't change, and your returns with that company will not change. So you, behaviourally, will have to change. Don't hesitate. Get out quickly. Do not give them another chance, okay? Don't hold on. If the story's changing, get out. Mistake number 5, I invested in companies where directors had hardly any skin in the game. By this, I mean they didn't have any shares in the company. I hosted podcasts, chatting to CEOs of companies who's given the big sell on their companies, and I've looked on the shareholder register, and they hold little or no stock. I thought, well, hang on, why are you asking other people to invest their capital, their hard-earned money, and you haven't invested yours? And the result of this normally is the companies, have management with very little skin in the game, who hold very few shares. They don't mind conducting placings at a discount. They're not aligned with shareholders. So they're not acting in the best interest of shareholders because they're not a shareholder. If they're shareholders of equal size, a big chunk, they care about shareholders. So lesson 5, I always now make sure directors have some skin in the game, or they're accumulating shares in the company in some way, Okay, that's the end of my 5 mistakes. Listen, I've made a lot more mistakes than that. But I want to keep the podcast to a reasonable level lengthwise. Otherwise, I can go on forever. But just as a reminder, mistakes are only mistakes if you don't learn from them. Otherwise, it's a lesson. As in life, when it comes to investing, you will make mistakes. It's inevitable. They will hurt, as the pain of a loss hits twice as hard as the pleasure from an equivalent gain. And you will continue to make these mistakes unless you consciously choose to learn from them. So, write your mistakes down, build them into your stock picking strategy, never dismiss your strategy as it was built through the experience of mistakes which have now become lessons. I have a strategy and it's built around that, built around my mistakes, also some of some things that went right. But if you avoid those mistakes, you will avoid the losers and you're left with winners. Never worry too much about mistakes, as they will make you a better investor if you learn from them. And I repeat, you can read all the books or watch all the videos you want on investing, but nothing can replace personal experience. I hope that helps. If you like that, then please share it, please like it, or subscribe for the next episode on the platform of your choice. Until next time.
The Share Pickers Podcast with Justin Waite. Building wealth through investing. For more information, visit sharepickers.com. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.